Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, April 18, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So across the board today, with some minor exception, we had a relatively flat day. So there's not a whole lot of change going on in the market, but we certainly have things to look at, and we're going to cover everything that I'm seeing underneath the hood of the market. So when you take a look at the Spider, we were up today a little bit, but not a whole lot. We went up earlier in the day, and then we basically just pulled back for the remainder of the day, for the most part, into the close. And let me just show you, well, before we do that, I'll show you the shorter time frame. But before we do that, take a look at where we went today. We have the line in the chart at 271.25. Here we have a high today of 271.30. So for all intents and purposes, that's a direct hit. And then we hit that level and pulled back, but we remain above all the moving averages on the daily chart. For at least the time being, that has to be looked at with somewhat of a bullish bias. Couple of other things of note on the daily chart. So number one is we have what I like to call a pseudo doji candle. So it's not necessarily a doji by the textbook definition of dojis, but I don't necessarily go by textbooks. I go with what works for me. And what I like to call this is a pseudo doji candle. It's basically telling us that there was indecision in the market today. There was no conviction on the upside. There's no conviction on the downside. In fact, there's no conviction at all. We had a very, very light volume day. We're at less than 55 million shares traded in the Spider. That's less than half the average daily volume. We're going to finish less than yesterday, less than the day before that. So that tells you that there's no conviction, there's no institutional participation on either side of the market. Before we go any further, let me interject a little commercial. Once again, I want to thank everybody for all the comments on the video. I love to hear different perspectives on what you think of the markets. Keep them coming. I like the interaction. I answer each and every question as best I can. In addition to that, keep the likes coming. Share the videos with someone you think can benefit from this information. Keep in mind, the comments aren't just helpful to me, they're not just helpful to you, they're helpful to the entire community because you may ask a question and I may give an answer that gives somebody else insight into something they were thinking about or potentially not thinking about. So it's helpful to the entire community. So please keep them coming. I love all the comments. All right, let's get back to the daily chart. Now, I mentioned the fact that it's a pseudo doji candle. Now, my preference is that these type of candles, the indecision candles, the doji candles, are better suited at highs and lows on charts. However, if we're going to get a lower high, for example, so here we have a high, here we have a lower high, at some point my expectation is we're going to get another lower high. Whether it comes from this area or it comes right here, we don't necessarily know yet, but this could be meaningful. We just don't know yet if it is meaningful. However, there is something else that's interesting. We are at a time frame, and this is something that's taught in detail in the course at Lazy E Mini Trader, and it's of extreme importance. We are at a time frame where the market is due for a trend change. So you take the pseudo doji candle and you take the fact that we're in a timing period where the market's due for a trend change. You take those two things, and yesterday where we filled the gap that was left open from the 21st of March, you take those three things together and all of a sudden the odds begin to tilt in the favor of at least a market pullback. Now, one might ask, and some of you will ask, and rightfully so, why am I discussing a pullback and I'm not discussing another leg down to make new lows? Well, because of where we are in the chart right now. We're above all the moving averages. We've gotten one heck of a move from all the way down here where we did make a low to where we are today, where we were yesterday, that's basically 150 S&P points. When the market rallies 150 S&P points, you have to give it, number one, credit for doing so, and you have to give it the benefit of the doubt that it may not just be over yet. So there's a couple of options. Can we do one of these? Here's a rally, and can we just collapse and make new lows? Absolutely. That certainly can happen. Can we have an ABC pattern like I discussed many, many times? Can we have the A leg up here? Can we pause over here? Can we pull back or retrace a portion of this move and then have another leg higher up to another level before we fail again? Absolutely. That is possible. I'm not suggesting that either of those drawings I just made are probable. I'm suggesting that they're possible. We don't necessarily know yet, and what we don't want to do is impose our will on what we want the market to do. If we have a pullback from here, for example, I have areas on the chart where I know that if we began closing daily below, then that'll increase the probabilities that we were going significantly lower. And if we don't close below those areas, then I know that it could just be a pullback in preparation for either a consolidation pattern or another move higher. Either way, that results in the same thing. We may not be done with the upside just yet. So for our purposes here, let's take it one step at a time. I'm not suggesting that we're going to have a down day starting tomorrow. What I am suggesting is, and I'll show you other reasons why I'm beginning to feel more confident that whether it's from here or slightly higher, the market's going to have a pullback. There's other markets that I'm looking at that are telling a tale. They're telling a story. But remember, above all these moving averages, you have to give the market at least a bullish bias until and unless we get back below at least the 150-day moving averages. Now, here's a picture of the 60-minute chart, and here's that 271.25 area. You can see what happened today. Here's the opening of today. So this is the first hour of the day. We traded almost up to that level, but we hit it in the second hour of the day, and right after we hit it, piercing it through or spiking through it by just a nickel, we basically traded sideways to slightly lower into the end of the day. However, what you have to also realize is, even though we had what can be termed as a pseudo doji candle on the daily chart, this is still bullish consolidation. We can still make another push higher out of this sideways activity that went on for the majority of today. Now let's take a look at the IWM. And we have some things to talk about in the IWM. Let's discuss why the market found a high today, where it found a high. So first off, you can see here that this pivot high from the 21st of March comes in at 158.26. What was the high today? Just move the chart over. The high today was 158.38. So we spiked through it by just a little bit and then backed off. So here's that high. We spiked it by just a touch, and then we backed off, and we put in a doji candle. We put in a tail candle. Again, keep in mind, and this is something that's extremely important from the Lazy E-mini Trader course, which is there's a timing mechanism where the market is due for a change in trend. Now, a change in trend doesn't have to mean we collapse back down. A change in trend means that we, at least from the perspective of where we are in the chart, at least stall out for the time being. That could mean we go sideways. That would be building energy for another push higher, or it means a meaningful pullback. Either way, we're in that timing zone where we should, under normal market conditions, see some kind of a stall, some kind of a corrective move, at minimum of a consolidation from where we are now. If we just absolutely push higher from here, then what I would say is that's likely into the end of the week. This is options expiration week. Expect the unexpected. But then at that point, I would be expecting some kind of a pullback beginning next week. But right now, we're in that time zone where it can be expected. Now, here's something else that we discuss quite a bit, and I want to talk about it again here. It's when you take a trade, having something to lean on, having something to, quote unquote, trade against. This is a very good example in the IWM. So we have the high today. The high today, again, was 158.38. All right. Now we finished at 157.48. Roughly, for all intents and purposes, it's about $1 lower. Now, if somebody wanted to be short, take a trade on the short side, wanted to be short the IWM, then you can take a short trade on a day like today. At the end of the day, because of this doji candle, this tail candle, and what you're trading against is any daily close above the high of today. It's that simple. If you close tomorrow above 158.38, then you move out of the trade and you will have lost, but you will have lost small and fast. Again, just like we discussed in the spider or on the spider chart, we're in that time zone where I am expecting a trend change to occur within the next trading day or so. Does it have to be tomorrow? No, it does not. But should it be within the next day or two? Yes, it should. Keep in mind, markets are based on probabilities. Nothing works 100% of the time, but the probabilities tell us that we're in for a trend change. Number one, we're into a very good level of resistance with this pivot high up here. We're also into a very good level of resistance on the spider chart. There is another level above, which you saw on the chart. We'll just bring it back real quick. You can see it up here, 274. Could we get up to 274? Yes, we could. Is it probable? I don't know if it's probable, but it certainly is possible. Can the powers that be, can the institutional money drive the market up another 40 S&P points between tomorrow and Friday during the week of options expiration? Yes, they can. Why would they do that? Because there were a lot of traders, a lot of investors out there betting on the short side. Now, not too heavily betting on the short side, and if you look at the put-call ratio, it's not that far off the zero line, meaning it's about 1. So it's not too far above 1, it's not too far below 1. But part of the job of the options desks at the big banking institutions, the investment banks, the big global banks that have prop trading desks, Morgan Stanley, Goldman Sachs, UBS, Merrill Lynch, a whole plethora of hedge funds, their job on the options on the options desk is during the week of options expiration, they run computer programs. The computer programs tell them where they get the biggest bang for their buck if the market closes at a certain point after the week is over. Meaning, their objective is, if you have bought a put, their objective is to make that put expire worthless or make you cover that put or sell the put before expiration at a loss. Who's on the other side of that trade? If you bought a put or I bought a put, who's on the other side of that trade? Well, it could be anybody. We never really know for sure. But what I can tell you without a shadow of a doubt, that the better bet and what the institutions will do way more often than not is they will sell premium. So if you're buying a put, they're selling premium. If you're buying a call, they're selling the premium. When you sell premium, it's working in your favor based on the time objective. If you buy a put or buy a call, each day that passes by, each day that clicks off the clock, time is working against you. If price goes in your favor, sure, you can make money. But if price stays the same or goes against you as time goes on, it exponentially gets worse and worse and worse. And by the way, just as a point of interest, why do you think they have all these different options expirations rather than just the third week or the third Friday of each and every month? Now they have weekly, they have options that expire 3 times a week, all kinds of stuff. They don't have that because the retail trader is making money doing it. The reality is that the majority of those retail traders, amateur investors, amateur traders that buy those options, they end up expiring either worthless or they end up selling them at a loss. and the institutions are the ones that are taking in the premium on those options contracts. The majority of retail traders do not make money buying puts and buying calls the majority of the time. Sometimes yes, but most of the time no. Think about this for a minute, and I think this is worth the extra minute of explanation. Where is your better bet? Is your better bet betting against the institutions or with the institutions? The answer is obvious, and if I'm telling you, and I am quite certain that the institutions are taking in or selling premium the majority of the time, then I would rather be on the same side of the institution. If I buy puts or buy calls and I end up losing the majority of the time, what does that tell you? That tells you I'm fighting the institutions. And therein lies the same premise as the course at Lazy E Mini Trader. What I teach in that course is how to be on the same side of the institutions. How to identify where the money flow is. How to identify patterns that exist on the charts and repeat over and over again. And the money flow and the patterns as a result of the money flow is where the institutions are positioning themselves for the next move in the market. You want to be trading alongside the institutions. You don't want to be fighting the big money players. That's the entire premise behind the course at Lazy E Mini Trader. All right, so back to the IWM. Not a lot new. I've talked about the tail candle. I've talked about the doji candle. We're in that zone where we should see a trend change. Doesn't have to happen, but my expectation is if it doesn't happen tomorrow, it'll most likely happen Friday or Monday. If we close above today's high tomorrow, for example, or any day above today's high, then we have to look for another signal. Because if we do close above, that would negate today's doji candle. Now here's the VIX. Now we did see a little tick up in the VIX today, up a little over 2%, but it was up a lot more earlier in the day. A lot more than I thought it would have been based on the market's activity. So the VIX turned around about 10:30 in the morning. So here's the opening. We see a spike up. This is a 10-minute chart. About 10:25 in the morning, you start to see us top out, and volatility got sucked out of the market, and we collapsed down for the majority of the rest of the day. Now that does coincide with where we found low in the spider chart, and you can see here, when I look at the 10-minute chart, where did we find low today? I'm looking at 10:30. Okay, so here it is, 10:30, 10:20. Here's where we found low today, but all in all, it really wasn't a down day. It really wasn't collapsing in terms of price. However, the VIX was certainly having a spike higher. I mean, from the opening today, so here's where the market opened today. Here's the close of yesterday. Here's the open today, 270.69. Where's the low today? 269.87. So it's less than $1. That's less than 10 S&P handles from open to low today. And when you look at the VIX, you can see that that was quite the rally we had from yesterday's close. Here is the 9:15 candle. Here is, where's yesterday? Well, this is a continuous contract, so my apologies. But anyway, here's 9:15. Here's the opening, 9:35 in the morning. So you can see here from the time we were at, let's say, 15:20, we went all the way up to 1690, almost 17 on the VIX. So what I mean by this, and the reason I'm bringing this to the forefront is, this is one of those things under the hood. This is one of those things that it doesn't necessarily mean everything today, but it's a puzzle piece that I want to put on the table because it may be telling us something of something else that's coming down the pike. Now here's the daily chart, and you can see we did still close below the 100 period moving average. We didn't go yet below yesterday's lows. We can still do that. We can come down and test this double bottom, and certainly this one here from the 9th of March, certainly if we get another rally in the market or a continuation move higher in the market, we'll see another collapse down in volatility. But I thought it was worth mentioning. I thought it was worth something that's interesting to note. That coupled with the fact that we're in the time zone for a trend change, we're into resistance in a lot of the markets. We put in a doji candle in the IWM. We put in a pseudo doji candle in the SPY. So there are a lot of things. There's a confluence of things I'm looking at that I think are important, and that's why I wanted to bring them to the forefront. I'm not suggesting we're going to see a collapse in the market tomorrow, but what I'm doing is giving you my thought process on how I look at and pick apart the markets, both from an intraday perspective and a daily perspective. Now, here's the transports. Here's a divergence. Now, as you can see, we found resistance up in this area here, and that's normal, common market behavior, right? That's garden variety. You find resistance, pivot high, and here's where we found resistance again today. But the transports were up nicely. The transports certainly cleared this red candle high that we've been talking about, so that's no longer an issue. This bearish pattern is off the table. However, when I look across all the markets, I have to note that the transports were extremely strong today. Again, my second favorite market leading indicator. So I called it a divergence because we just talked about other things that are pointing to at least a stall out in the market, meaning we're going to stop rising for a couple of days at minimum. But here we are in the transports, and we have a huge up day, up 177 points, 1.68%. That's a big up day in the transports. Is that telling us that higher prices are coming and all that other stuff we just talked about is a one-day wonder? It's possible. I'm watching it very closely. It's certainly another puzzle piece that has to be put on the table. And herein lies where the market's job is to make it difficult. It's the market's job to make as many people, as many traders, as many investors look like fools as much of the time as possible. So here we are with part of the market telling me one thing and another part of the market telling me something else. That's why I called it a divergence. The market never ever makes it easy. Our job is to decipher what the highest probability thing in front of us is. What I can tell you about the transports is that if we get above here on a daily closing basis, okay, whether it's tomorrow or at any point beyond now, then that's bullish and there's higher prices coming, right? So this should be a pretty good level of resistance for the transports. In addition, and this is something that I discuss in the course at Lazy E-mini Trader, so from pivot high to pivot low, this was a normal garden variety retracement. We hit it again here, and now we hit the same level here. How many times are we going to hit that retracement level before it breaks through? The more times you bang on something, the more opportunity you have for it to break through. So it's up in the air. I'm watching very closely. It's interesting that we had a very big up day in the transports, but a pretty flat day across the rest of the markets. The S&P was only up about 2 points. The Dow was down 38 points, and the NASDAQ Composite was up 14. So the NASDAQ's flat. Up 14 is closer to flat than anything else. The S&P is closer to flat than anything else, but the transports were up. So I am watching and paying very close attention to the transports. The financials, XBD, broker-dealer index, continues to struggle. I find that very interesting. So we continue. We had a pseudo doji candle yesterday. We can't get above this breakdown candle high. We have a down day. The financials are struggling. The XLF, which is the other financial related ETF that we looked at yesterday, that's struggling. You look at the weekly chart, okay, and you see a very well-defined bearish pattern. This will generally, and more often than not, way more often than not, play out to the downside. When you look at stuff like Goldman Sachs, this is a weekly chart, same bearish pattern. This will generally play out to the downside. Goldman will not become bullish until and unless we close above this level here on a weekly basis, okay? How about JP Morgan? Here's a weekly chart. What is this telling us? This is telling us the next likely move for JP Morgan is in the downward direction. When you look at the daily chart, this is not a healthy chart. On the daily chart, we're below the 50, 20, and 100 period moving averages. This is telling us lower prices are coming. This is not a healthy chart. It's not completely terrible, not just yet anyway. However, what I can tell you is that if these lows are broken, look out below, lower prices are coming in JP Morgan. And if JP Morgan's on the way down, the market's likely on the way down. It's unlikely that we see a rally in the stock market as a broad index with the financials going in the other direction. That's just an unlikely scenario. And here's another one of those things that I mentioned early in the video that I wanted to talk about under the hood of the market. Here is the Philadelphia Semiconductor Index, the SOX. The SOX was down 1% today. So the SOX is generally a pretty good leading indicator of the markets. I don't necessarily discuss it each and every day, but I certainly look at it each and every day because the semis do lead the market in either direction. The semis struggle today, down 1%. When you take a look at the longer-term chart of the semis, the weekly chart, technically speaking, there's not a lot wrong with this weekly chart, okay? We're above all the moving averages, and if we remain above all the moving averages on the weekly chart, then higher prices can certainly come. And what I like to do is point out, and I haven't pointed this out in quite a while, and this is very important. When you see spacing in between moving averages, all right, so you can see here on the weekly chart, there's spacing, and it's actually getting wider. That's a bullish sign, spacing between the 50 and 100 period moving average. It's parallel or getting wider. That's a sign of bullish behavior. So while the semis did struggle today, as long as we remain above the 20-week moving average, which comes in at 1323, which is quite a bit below where we are now, then technically speaking, there's not a lot wrong with the semiconductor index. Again, we're above all the moving averages, but I will note, and it's a puzzle piece I'm putting on the table, that we were down 1% today in the semis, so it could be the start of something. It could be a potential canary in the coal mine. We'll see. And this is why I used the word before, divergences. We have the semis down, the transports up, we have a doji in the IWM. We have a lot of different things. We have a confluence of different things working potentially against each other that generally doesn't last for long. Generally, the market's going to correct itself in one way or the other, meaning divergences are typically temporary. The gold market, not much doing today in the gold market. From a daily chart perspective, we're above all the moving averages. This just is not a negative chart. And I know I've been talking about GLD and how we have this tail candle and that it's a potential short if we climb up a little bit more than we did today, up about halfway up that tail candle. But I got to tell you, I'm not 100% convinced that's the best short on the planet. Why? Because we are above all the moving averages, and while it may produce a short-term trade, and that's fine, and you do have something to trade against or lean on, which is the high of the 11th of April. So as long as we don't close above that high, then that short trade can stay intact. My thought process is, as long as we're above all the moving averages on the daily chart, it's just not the greatest short in the world. I'm not sure I will be taking it. The other reason is, when you look at the weekly chart, and here's the weekly chart of GLD, again, above all the moving averages, this from a weekly chart perspective is telling me that it's building energy to push higher. It's telling me higher prices are coming. In my book, there's nothing wrong with the gold chart. In my book, while we could get a short-term trade to the downside off that tail candle on the daily chart, the weekly chart is telling me higher prices are coming, and that's really, I'm going to go with the longer-term perspective. Here's the actual commodity itself, the GC, the gold chart, and again, weekly chart above all the moving averages. This is telling me it's building energy for another push higher. And the thing about gold is you can wake up one day and something from a geopolitical perspective has happened overnight and you find gold up $20 or $30. Who wants to get caught in that scenario? So that being the case, bullish above all the moving averages on the weekly chart, I have to go with what the longer-term picture is telling me. The longer-term picture is telling me that higher prices are eventually coming in the gold market. Now, here's crude oil. This is the weekly. Let's go to the daily. Look at this move in crude oil. We've been discussing the fact that higher prices are coming in crude oil. In fact, I've been discussing higher prices are coming in crude oil from back here from up here, and even from down here. We put in this trend line, the trend line held. I've been discussing the fact that I'm looking for $73, $74 on the upside in crude oil for months already. Here's the weekly chart again. What's the weekly chart doing? It's breaking to the upside. There's my number. The exact mathematical number that I have is $73.78. Doesn't mean it's going to hit it and reverse. Could get up to 74, could even get up to 75. It's a nice big round number. That's certainly possible. But what I'm going to be doing is when crude oil gets to this price, if it should get to that price, that's when I'm going to be looking for signals of a trend change, because this could be the short trade of the year, in my opinion. Not now, but up near that price. We have to see it when it gets there, but my take is, and it's been like this for a very long time, that we're going to get up there, and when we do, we're going to be looking for signals of a trend change. And with that, folks, it's everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market